Hello and welcome to tonight's Wealth Builders webinar. I want to tell you, you are in for a real treat because we have our very own founder of Wealth Builders, Billy Epperhart, that is going to be joining us tonight and is going to be sharing information. Billy, do you want to say hi to everybody?
Hello, everyone. I'm excited to be with you. I think it's been a while, Karen,
It has.
since I've actually been able to be on one of these, but I'm excited for the webinar tonight.
Oh, thanks. We are so happy to have you, Billy. And we've got two of our amazing coaches on tonight. Frank Pulley, who is a genius real estate and business coach. You want to say hi, Frank?
I'll send you your money later. Thank you for those kind words. Hey, everybody. Thanks for joining us. We've got some really good, interesting material for you tonight.
Great. And we've got our very own Pastor Mike Davis from Pueblo, Colorado. Mike, do you want to say hi?
Hi, and we are so excited. We're ready to hear from the man.
We are. We are. And we know while people are signing on, let me ask you something tonight. If you are on, just type in chat like your name and tell us where you are tuning in from. We love to do shout outs and just see where you're joining from, because usually we've got people really from all over the world. So I'm going to be looking for those names. Oh my goodness, here we go. Haley Wall from San Antonio, Texas. Sarah, one of our amazing coaching clients from Michigan. Good to see you. I owe you an email, girl. I just saw that come in today. We've got Joe from Colorado. Wow. They are going fast and furious. Susie and Philip from Florida. John and Lori, more coaching clients coming in. Jack Clifford from DC. Renee from Delaware. Maureen from North Carolina. You guys are in different computers. We've got Tom coming in from West Texas. Vincent from Houston. Daisy from Ireland. Hello, Paula from Loveland, Colorado. Victoria from the UK. We're so happy to have you. Joy from England. We've got Bob tuning in from Central Florida. Larry from Central Texas. Guy from Palm Harbor, Florida. My goodness, you guys, you are from all over. This is amazing. We are so blessed to have you here. More Louisiana. We've got Marva from Missouri, Raymond from Baton Rouge, Andrew from Columbus. We've got, oh my goodness, we've got, is it Kaimo from Estonia in Europe. Wow, Mike from Colorado, welcome. Thank you so much for being a part of this tonight. Well, Mark and Jennifer are on. Hello, my friends from Tennessee. Natasha from Chicago. Wow. It's just a family, I'll tell you. Well, tonight I want to remind you that this is an interactive webinar. So what I mean by that is that we're going to have time during and at the end where you can ask your questions, and we will answer as many questions as possible. And of course, we're very excited about the upcoming business and nonprofit workshop. This is such a special workshop. And Billy, I don't think I've even told you this, but we've got some pretty fun things planned. One of them is going to be like a live coaching session, sort of like a Shark Tank, where we're going to choose one person from the audience that has got a business and bring them up on stage, and the coaches are going to help you and answer questions for you and give you some guidance. Also, we've got 12 workshops happening on Saturday afternoon, and we have incorporated a group of workshops that are hands-on for small groups. So lots of fun things happening. So I know you're all excited to hear from Billy tonight. I am so excited to hear what he has to say too. So Billy, we're going to turn it over to you.
Well, thank you, Karen. Hey, who are some of our speakers that are going to be there for the workshop?
Well, we've got Frank Pulley and Mike Davis that are on here. Of course, Billy Epperhart. We've also got Jeff Vanderwall, who is an amazing businessman, owns car dealerships and more, that is out of Denver. We've got Colin Carr, who many of you have heard from. We've got David Lapp flying in on Saturday afternoon with all the Lapp brothers. We're excited about that. My own Dave Metcalf is going to be there, and we've got Bill Bronchek. So we've got a loaded group of speakers, and you know what? We're all in the game, and so that really makes a big difference.
Makes it, man. I'm going to come to that one. I think I want to hear everybody to be on there. That sounds pretty good. Well, it's been a while since I've been on here and kind of talking about an economic update, and one of the young ladies who you and I depend on a lot, Gabriella. We love Gabriella and Larry
We
both.
do.
And Gabriella's really the manager of our office, right?
She
They're
sure is.
Wealth builders, and she does a lot. She carries a big load. But I've been talking to her to try to talk to her and Larry about maybe helping them in some form or fashion in getting in a home. And so I went around and looked at a few houses in the Denver metro area recently. And I looked, they don't know, she doesn't know all this, but she knows the first part. I looked at some homes that were in the $550,000 to $600,000 range. And then I looked for some that were in the $600,000 to $700,000 range. And then I looked at a few that were above 700. And, you know, I learned something myself, and I'm going to admit that right in front of God and everybody on here. I realized that young couples trying to buy their first home, they've basically have been priced out of the market right now based on their just normal, what we would consider normal income. So one of the things, and I'm going to talk about the whole market here in just a second, not just real estate, but in talking about real estate, one of the things that I think we need to all know, the environment that we're in currently, is that we've had our real estate prices have gone up in the environment of low interest rates. And so if you've heard me talk much, you know, I call that cheap money. So these low interest rates, and so this, you know, these 30-year loans that were 2.75 or 3% or 3.25. Well, what happened was there was a lot more buyers in the market that could get approved to purchase those properties, especially that, you know, in Denver right now, that beginner house is really 500 and above, and in most areas. There's some areas that are a little bit lower than that, but for the most part, it's, you know, 500. Used to, that was a really nice home. The reason I'm bringing that up is because what I realized was the asset prices, the real estate prices, have not yet started reflecting the higher interest rate prices. And so buyers themselves are getting basically priced out of the market. And so you say, okay, that's wonderful, but what do we do right now in this environment we're in? And, you know, how do we handle it? And I think one of the things that we all need to be clear on here is, because of that, at some point, these asset prices, now we're talking about a piece of real estate, are going to start reflecting the higher interest rates that we're in now. So, you know, one of the things I want to encourage you to do is we really need to see where we're going to be next spring. Now, I know some of you that are trying to buy a house right now, and you want to buy a house. I understand that. And so if you feel like you need to, one you're going to live in. But for the investors that are watching, I think we need to watch this market. Now, I'm going to give you another, as Paul Harvey would say, the rest of the story here in just a second. But what I want to say is that right now it hasn't changed. So what was going on? We had these low interest rates, a lot of people in the market. And what has held these prices up, I've talked about this before, has been the inventory. So the inventory has been so low. But what I think where we're headed right now is that inventory, even though it's going to continue to stay low, the inventory is actually going to start growing because people can't purchase, or they can't buy. So we know a lot of people feel locked in, for example, because they're in these low interest rates. Over, I think it's 90%, 85 to 90% of current mortgage owners that have bought in recent years anyway, they're in these low interest rates. And so therefore they're not, you know, they don't want to lose that. And so the inventory has stayed kind of low. But another reason inventory is low is because the prices are so high right now. There's not that many people that can afford to buy those starter homes. So that is kind of the big picture of where we are. And I would like to see where housing is going to end up as we look in the spring, just to kind of learn. So right now is a good time to learn. It's a good time to get coaching. It's a good time to understand. However, the second part of this is that some of you may know this, but yesterday we had 10 regional banks that got downgraded. In other words, their credit ratings and their strength of those banks were downgraded. And I brought some statistics here with me as I get into this. And we actually, the biggest bank to receive a downgrade yesterday was the Buffalo-based M&T Bank, which is the 19th largest in the nation by assets. So that's a really big deal that it got downgraded. It's the 19th largest in the nation by assets. And then Moody's, the actual big credit rating agency, in addition to the 10 banks that got downgraded, those were what we call regional banks. Some of them were a little smaller, some of them are a little bigger. They received the downgrade. And then there's 11 more banks that Moody's assigned a negative rating to. And then as they started reviewing, they're looking at some of the bigger downgrades that are coming. Some of the biggest lenders that are actually in America, PNC Financial, Capital One, and Citizens Financial, they all received kind of negative ratings in regards to where they are. So people are listening to me right now. They go, well, what does all that mean? Well, one of the things that we have to understand is with these rising interest rates, bonds have done a lot better. Current bonds have done better. In other words, the prices that bonds are paying. But what it means is that the actual credit system in America is beginning to kind of falter some underneath these high interest rates. And I know people don't understand why, but the reason is that they have assets on their books in those banks that where they are actually, the bank itself is actually earning much lower interest rates than what the bond market is paying right now. And so because of that, they can't keep up, for example, with the cost of capital, which makes their balance sheets weaker, makes their loans weaker, makes their strength weaker. And so because of that, there's kind of some cracks that we're starting to see in the financial system. And so you say, well, where does that leave me? Well, as I'm talking to you now, I've been coming on like this now for 18 months talking about this, but it seems like everything I said was 6 months to a year out is actually happening 18 to 24 months out. Because we're going to start seeing it reflected in the actual lending markets itself. Right now, money's tight because of high interest rates, but even the criteria for getting approved for loans is going to increase. A lot of people think it's going to lower, right? They think it's going to lower because people are trying to get mortgage loans done. But if prices stay up, that lending of houses, that lending criteria is going to go up some, and you're just going to see the market continuing to tighten. And so the U.S. government's downgrade went from AAA to AA plus, which if you go back and look at history, that is a historical event. Just for the U.S., what the United States government is guaranteeing in their bonds, that got downgraded this week. Then these banks that I'm looking at here on my iPad, they've gotten downgraded, and there's quite a few more banks to come on this downgrade. And so the concern that I have, and I just want to say it, is that you need to keep your financial resources, if you can, dry, and you only do deals, if you're buying property, you only do deals that really have to make a lot of sense right now, because I'm convinced that as these banks are continuing to get downgraded, what's going to happen next is that the stock market, and remember I told you this tonight, this is August the 9th. Remember I told you by the middle to the end of September, you watch what's happening in the stock market. So because the stock market right now has been registering nothing but good news. Now today it was down some, but what's happening is that's beginning. I'm convinced that the stock market is going to start registering some of this criteria. Now I'm going to do something. I know so far this has sounded technical. I apologize ahead of time for sounding too technical, but I want to tell you this. What's happening is because interest rates are going up, the bonds, the government bonds, the 10-year treasury is probably going to hit 6%. So there's a thing in finance called the risk-free rate. And the risk-free rate just simply says, if I'm going to figure a calculation on what something is going to return back to me, then let's say I say something is going to pay, it's going to pay me 8%. And let's say the risk-free rate is 6%, then the benefit of that investment for me is 2%. Then I have to consider the risk that I'm taking. And if my risk is more than 2%, for example, it's not apples with apples. Let's say my risk is as high as 10%, then that 2% delta that I'm getting on top of that is not a positive, is not a good return for me. You say, what does all that mean? Here's what it means. When they start applying the risk-free rate to the stock market and what stocks are paying, what's going to happen is the stock market is overvalued. It can't anyway match up to what we're seeing in the bond market right now. Because of that, the stock market will react adversely to what's happening in the bond market. So the only thing I'm saying is always remember in the economic arena, you have basically inflation and growth. And then you have interest rates that affect both of those. And so right now we're seeing where growth has slowed down. Inflation is starting to come down, but it hasn't come down to where we need it. And so the Fed is going to raise interest rates again, probably I think they could go potentially as high as 50 basis points, but I know 25, that means 0.25% that they're going to raise it. And we're going to see the bonds start paying a much higher yield. And because of that, something has to give. In fact, if I was going to title this webinar anything, I would title it right now on August the 9th, 2023, something has to give. Because what's going on right now is unsustainable based on these rates are still coming up. House prices are still up. The market, as I'm recording this today, is still up. Something has to give under the weight. And I'm going to tell you, the balance sheet of these banks is hurting because they have put all this money in reserves into assets that are paying lower interest rates, and they've leveraged themselves. And so what happens when other interest rates on bonds go up, the bonds they're holding and their balance sheets go down in value. So they may, for example, they may say, well, this bond is worth $100. With where interest rates is coming up, that bond now is only worth $70. So all of a sudden they don't have that. They just lost 30% of their assets on their balance sheet, which makes their balance sheet look weaker, which then weakens the financial system. Now, I know the last 10 minutes have been technical. So let me just say this. We need to be cautious, and we need to slow down right now and see what's going to happen in the markets. And right now, if the Fed goes up again, I am telling you, the real estate market is going to come to a halt, and only those with the best credit and the most money are going to be able to buy their personal homes. Now, the good side of this is at some point on the other side of another year or so, I think we're going to have some real bargains in the real estate market before interest rates start coming back down. But asset prices have not yet yielded to these high interest rates, and very candidly, these high yields that are now in bonds. And so it hasn't, the assets in the market haven't registered that, and it's going to start registering. So just remember, something's got to give. That's what I'd title it. And so let's look at the middle of September to the middle of October and see how the stock market is reacting. So Karen, I think right now, I know this is not overly positive in my outlook, but this is probably the other warnings I have given before have kind of been out there, and let's watch. I think this one is closer than it's ever been. Now, the government could step in, but if the government step in and it rescues these banks, I'm telling you, the stock market is going to register it, and it'll stop housing for the time being. So we need to be aware of what we're doing in our investments.
Wow, that's so interesting. And, that's a lot of why we just, Billy, love to hear from you to see what is going on. So, in any type of market, oh, and I just want to remind everybody, we're going to answer questions for you. So, if you've got a question, go ahead and enter it into the chat or the Q&A section, and we'll answer as many as possible. If you're watching on Facebook, enter it in the comment section, and we'll get that forwarded to us. But Billy, with this, it's a lot of indicators. I think the way that you just recapped it, like, wow, something's got to give. But in that, where's the opportunity? So is there a buy and hold opportunity? Will rental rates go up because unfortunately these home buyers can't afford a house? Where's that silver lining?
Well, right now, I think there is a little bit of upside on rents, but what's going to happen with the economy tightening, rents won't go down, but rents may get tighter. The issue is with rents is that people cannot afford, especially these truthfully, the first two levels of home buyers. So the way it works is your beginning home buyers cannot afford to buy. Your beginning home buyers. Then what that leaves is that person going from their first home into their second or third home, then they have a hard time buying the homes they want. And so if they're going to buy something new, they would have to go to what I would call the starter home. They don't want to do that. They're either already in a starter home at a good interest rate. So it's something has to give. So I would say for investors right now, your rents currently are safe because the Fed is still raising rates. But at some point, I think I'm not concerned at all myself about rents going down. Not yet. We would have to get, we're still in an inflationary period as we're recording this. We'd have to get into a deflationary period for rents to actually go down. And I do not see that happening. Now, I do see the recession that we've been talking about now for 18 months. And I do see a landing that's coming in. It honestly, we've already been kind of in a recession anyway, but a psychological recognized recession, I think, is coming. And as this money that's been washing through now for the last 18, really 3 years, this money's been washing through. We're finally getting to the point now where the banks are becoming the first indicator of that, the negative response to that, as opposed to the actual stock market, which I've always called kind of the leading thermometer. But what's happening right now is the banks themselves, which typically you don't see that until later. But right now we're seeing it right up front because these rates have so harshly affected them. And so what I said earlier, Karen, about the value, I don't think I talked about valuation models, but the way it's working on the stock market is some of the big money is going to start coming out of the market, which is going to make the market go down because what we call valuation models and valuation methods are actually telling us that some of those investments that they've considered to be worthy of a certain price, they're not going to be worth that price anymore. So I think for those, the everyday Main Street person watching this, first of all, something's got to give. And secondly, be slower about what you're looking to invest your money in. And those that already have real estate, just hold tight. We're going to be fine. For everyone that owns real estate, you're going to be fine. But I do believe on paper, I don't think rents are going down, but I believe prices will go down. And very candidly, we need some prices to go down and get the market balance back again. And then I think in maybe 2 years or so, we'll get back into that 4 or 5% interest rate level once inflation has cooled. But part of what's driving this right now is not just inflation, it's the results of inflation and what the Fed has done to stop it. Now we're starting to see it kind of have a domino effect into the actual financial and credit markets.
Wow, Billy, this is amazing. And we have got questions coming in like fast and furious. And so let's get started on those questions. Are you good with that?
I'm good. I just took a drink. I'm good.
All right, great. This first one is from Janet, and she says, so if I have $50,000 in a growth stock, should I move it to a bond?
Well, I would tell you, if you have 50,000 in a growth stock, and I'm assuming by that question, you mean one stock, I certainly would, we call it in the industry, Wealth Builder Investments, our RIA that we have, that Chad Franson and I have together, we would call that reduce your exposure to that, especially if it's just one stock. And I would look at kind of getting maybe in some other areas, and I don't want to give too much direct financial advice here, but I would be cautious having everything you have in one growth stock, and I would sell some of that exposure and either go to cash, and then we can talk about the bonds and some of the other things maybe as we get into it. But right now, just a good money market for the short term would be good, probably where she's at. But I wouldn't have the whole amount in a growth stock.
Wow, that's so good. All right, this question is from Shelley. And she says, if one of our kids was about to get their first home, should they hurry up now before the rates go up?
Well, my answer to that is that if they, number one, if they can afford it. Number two, if they're going to stay in long enough that they can refinance into something lower in 2 to 3 years, and they're going to enjoy it. Because when it's your personal home, it's different than, for example, an investment property. Investment property, you need to look at it from a few more angles than you would. But if it's your personal home and you can afford it and you want to pay for it and it makes you feel better, go for it. So you have a place to live and you feel good about it. But the rates that I think right now, I just looked before we came on, I would say the normal average buyer is going to be at about 7.25. And let me just say something about that interest rate. The other thing that people need to realize is that these young couples trying to buy, most of them don't have 20% to put down. And so what happens is you get priced, you're going to get, so if you have 10%, right, anything less than 20%, you have to pay for mortgage insurance. And if you look at what mortgage insurance costs you, best case, you're going to be at somewhere between 0.5 to a full percent above, in addition to what you're owing on the loan. And so when you look at that and you start looking, I mean, that's a lot. And you start looking at what that costs, so the ratios for a house, all right, you need 28% for your house payment of your monthly income. So if your monthly, let's just keep it real round for a minute. If you make $10,000 a month in household income, which is $120,000 a year, that means you can afford a $2,800 house payment. And then any other debts you have to be combined with that 28, and it goes up to 36%. So right now your total indebtedness that means $3,600 a month is what you can afford in total payments. That's your car payment, house payment, whatever else you have. And so that market is as tight now as it has been in the lending standards. So that's what I mean by that. And then if you add that mortgage insurance on top of that, that's going to take that ratio down because your payment's going to go up. So it's tough right now on people, especially young couples. So my answer is, if they can afford to buy it, they like it, and they're willing to live in it long enough. Because here's what I think: if you buy it now and you're going to try to sell it in 2 years, you may lose money.
Wow, that's so helpful. Okay, this is a follow-up from Shelley, and she says, based on the bank downgrades, would you recommend holding more cash in gold?
The short answer is yes. But when I say this to you, the reason that I don't just answer questions like yes or no, because it depends on that person's own financial situation and where they are, and not to sound too complicated or trying to crawfish out, but right now, in August the 15th, 1971, Richard Nixon got on TV and he made the announcement and he took us off of the gold standard. Mm-hmm. And from that time, and money at that, gold at that time was considered real money. That's what it was considered. We are in a time right now where gold, once again, and precious metals, but gold specifically, in my mind, I still consider that real money. I got something and I'm here. And that's how I look at it. And right now the way it worked was this. Let me say this about gold. The way it worked in August 15th, 1971, it changed on August the 16th, 1971. But on August the 15th, 1971, if I had a $10 bill, I could go to the government with that $10 bill and get $10 worth of gold. It was just like a check that you would write on the money that's in your checking account. And what they did was they took the money out of the checking account and they started printing money. And today we don't really have a valuation on the currency. What we have is hopefully the good faith of the United States government and central bank to make those dollars good. And so that's what we all been living by. So right now I'm concerned enough that in fact, I just told Becky, my wife, Miss Becky, I just told her, I think 2 days ago, I'm getting ready to buy some more gold.
Wow, very helpful. All right, this is from Jay. Billy, are you concerned about deposits in these institutions, and do you think default on U.S. Treasuries is a concern?
Well, number one, just make sure, I think the United States government's still good. So I don't see any concern for default on U.S. Treasuries, but make sure in your deposits in banks that you're not over that $250,000 limit. And just make sure that, matter of fact, I opened a new account at another bank just this week. What is today? Wednesday? Last Thursday, I opened a new account, 2 accounts. So I'm in several banks now, maybe 4 or 5 in my normal stuff. And so I think right now you need to be concerned because that insurance is up to $250. Some banks have it. Well, they'll ladder it for you. They can take your whole million, for example, and then they'll put it in 3 other banks so that you actually have a total of 4 banks and all of those are insured. That's a program that many banks are functioning with right now. But if you're, I would talk to people in your bank, ask them how's my bank doing, and just see what kind of response that I'm actually meeting with the president tomorrow. When do I meet? Next week, early next week. I meet with the president of a large regional bank that's coming to my office here in Woodland Park. They're a big operator, large bank, to try to go over with me the condition of the bank. So I think all of those things are important. Now I'm happy to be in a situation where they come to meet me. So that's kind of nice. But, I think what happens is we're able to talk and find out where we're really at.
That's great. And too, if people have got more than 250,000 in a bank, go in and just make sure that your ownerships are different. That can extend your coverage too. You can definitely move it over to another bank, but if you've got that amount in one bank, at least check into your ownership and make sure that you can easily get additional coverage based on that.
Yeah, that just means a different tax number. So whether it's an EIN for a business or whether it's a social security number for an individual.
All right. And then Austin says this: I invest in long-term single-family rental properties. Do you advise to wait until this market correction to purchase more homes or continue as normal when deals present themselves?
If a deal presents itself and you're getting the cash flows that you need, and actually, I think we're going to start seeing that sooner than later, but and your numbers work, then do the deal. If your numbers work, do the deal. What you have to be careful of right now, especially careful of, is the deals are getting smaller and smaller, just so we're clear. You have to, do not surrender your margins. In other words, don't say, well, I'll just make this one happy. Or I'll get happy for doing it and I'll just make this one work. But you need to make sure your margins are good. Secondly, just make sure right now, especially, you don't over leverage, because that interest rate that you're getting, let's say it's at 7.25%, or in some cases, I know from people I've talked to recently, can get up close to 8%. Just as long as your numbers are working there, then when rates come down, you're going to be in great shape.
Mm-hmm. That's really good. Okay, Samri says, what is your advice on purchasing a new car now?
Well, I'll have to probably defer to somebody else on that. I don't know. I know we got some other coaches on, but right now, the car market, I just talked to, I know Jeff Vanderwall speaking at our workshop. I just talked to him. I saw him last night. And what's amazing is the car prices are still staying up with these interest rates as high as they are. So the title of this podcast is Something's Got to Give, because people can't afford these cars. And so I think, meaning, it's crazy. I mean, I actually had Jeff sell a truck I had leased. I bought another one, paid cash, but I had one leased because I get that write-off, and he sold it. I've only had this happen twice, and it's been in the last 3 years. I sold 2 trucks and made good money under a lease, paid the lease off, and put in the first truck, I put a bunch of money in my pocket. Second truck, I put okay money. So just telling you how high these prices are with any kind of real asset. It's amazing. And we never even called vehicles an asset. I mean, I always called it a liability.
Yes.
The truth is, these used cars right now, in some cases, are going for more than new cars. It's crazy.
Wow, that's so interesting. Okay, so Nana says this, thank you so much for providing all the great information. What should I be doing since I'm hoping to go into property investments like flipping?
Well, so, right now, so here I go, Karen. Yeah, you and Mike and Frank are going to have to bail me out, but you have to be really careful about flipping right now, because, so I'm going to give you something that's worth the price of the ticket. If you're going to get into flipping, you need to have financing and the ability for somebody to purchase the house from you. You have to show them how to get approved and what to do. And right now in this market that we're currently coming into, you have to, I tell people this in commercial property. And by the way, talking about banks, one of the downgrades is not only because of what we're seeing in the bond market that's happening, but it's also because of the commercial portfolios that many of these banks are holding, and those pieces of real estate are getting hammered. I mean, they are getting, it's crazy. And so the reason I say that is that's another reason their balance sheets are looking so weak, is some of them, not all of them, but some of them have heavy exposure to commercial real estate. Flipping. So on flipping, you have to be careful. If you're making money off of, meaning you want to make money off of flipping, my opinion right now, this is not a flipping market. Can you find a deal here and there? Yeah, but you really need to know what you're doing in order to make money. Some markets, any of us can make money. This market, you need to have your teams in place. You need to have your financing in place. You need to have how you're going to sell it in place, because the markets have tightened up.
Thank you so much. That's helpful. Frank and Mike, I just want to give you an opportunity. Do you have anything? We have someone else, Nancy's asking if they should pause and wait some time before looking at investment properties. Thoughts? I'll start with you, Frank.
Well, I mean, as Billy said, there are deals. As long as you adhere to the formulas and maybe bring yourself just a bit of being, a little conservative, I think you're still okay. Now with flips, I'm following you, Billy, just like the short sales of the mid 2000s, like following a ball downhill and trying to hit the price down here. So,
Right.
Although I don't think it's going to go like this, if you're going to do a flip, you got to do it in the right market, and you got to make sure you build extra conservatism into your deal. Billy said, if you can find your back end buyer, that's even better. And if you can't, I found that, December is a great time to buy properties, but I've never found December was a great time to sell them. So the holidays. So I try to not let any flips end up between about the 1st of November and the end of January. Just found it takes a lot longer.
That's right. It's Thanksgiving to Super Bowl. And the truth is, I always put the last day of October, and then usually the week after Super Bowl, you can start listing. So that's really the number. So you're right, Frank, about that. The actual season that we're coming into also makes it more difficult in addition to the current economic climate.
Well, Mike, your thoughts about, is this a decent time to purchase?
Well, I just know, like, even in Pueblo, I've got a daughter who just moved to Denver, and she had to pay in the mid 600s to get a house. And my son just purchased a home here in Pueblo with was the mid 300s. But the good thing about him, you were talking to Billy about these young couples, how can they afford it? The great thing about him is his first home buyer. So he did get into a program where he didn't have to put down as much for the down payment. But it was a strange, Karen, you may have heard of this. It was a strange loan because he has to pay PM. Of course, he'll refinance, like Billy said, in a couple of years, but he had to pay the PMI, they said, for the length of the loan, 30 years. I've never heard of that. I just, you get down to 20. I told him, I said, well, 20% is usually when they take that off.
Yeah, you have to refinance.
Yeah. But he got 5.9%, which is much
that's
better.
awesome.
Yeah, it's the first home buyer. But I tell you what, they pulled them like through a knothole backwards as far as going over them and going over there. It was like a roller coaster. They were up one day saying, okay, this is going to go through. The very next day, it doesn't look like it's going to go through. The lender would call them, the underwriter would call them. And you talk about being tight on everything, Billy. You are so right. They just, because the interest rates are going up, people think, oh, it should be easier to get a loan. And he's got upper 700s for a guy in his 20s.
That's
Hundreds
good.
for credit. I mean, I thought this would be a shoe-in. It was not. It was tight. I mean, he said him and his wife, now he just got married, but they were so stressed out. I had to pray for them and calm them down, like it's going to be right. It's going to be all right. It was the most stressful I've seen for somebody to buy a home.
Yeah,
Wow.
just think if somebody bought a house like that and they were trying to flip it, I want them to understand that's who's trying to buy it, is those young couples.
Yeah.
Are having to go through that process. And so the underwriting criteria, because these banks cannot have loans. And of course, we know it's Freddie and Fannie that's behind it, but these banks cannot have these loans going bad. And so the criteria is getting tougher.
I've got a friend who's a flipper here, and that's what he does for a living. Matter of fact, he's become a millionaire over it, but he has had to tighten. He's a contractor, and he's always had a team of people, of contractors, to help him. Well, guess what? He's starting to get his hands dirty because of the numbers being so tight. And if you do the work yourself, then you can maybe flip.
Absolutely.
Do it yourself.
That's correct. Yeah, you'd have to do almost all the work yourself. And to be very candid, it's better if you have the cash yourself. If you do the work and you have the cash, you can probably make some flips work. But I'm telling everybody listening that if you're going to flip, having that back end buyer, making sure that system is in place and you know how to help people get approved. Let me just tell you, that's a big deal.
Yeah.
If you didn't send them to a mortgage broker or somebody and you haven't kind of pre-qualified them or help them understand what it's going to take. I tell people that in the commercial business. If you're in the commercial business, you're trying to sell something. Most of the time, you have to teach some of those, even commercial buyers, how to go get the loans at the bank. And therefore, you can flip quicker if you have that system in place. But I'm telling everybody, listen, it's tight right now for these buyers trying to come in and get in these houses.
Wow, thank you. All right, we're going to switch gears a bit here. Laura is asking, what about preferred stocks in the bank sector now? And what about T-bills?
Well, I think that, your T-bills are still strong, right? So probably what's happening is that we've moved now. We're moving, let me be accurate. We're moving now from where the only lower risk bonds were just short-term bonds, even though that's still the case. The short-term bonds are still the safer bonds, but we're starting to move into an interest rate environment and what they call a yield environment, where sometimes now the 10 years are starting to look a little more appealing based on the yield that they're giving. And so I think right now the T-bills, especially if you just want to be safe, you're just getting a 2-year T-bill, something like that. And that's typically safe. A year ago, I'd have told you getting a 1 year. And so I think right now you need to understand, but you're going to get a higher before up until recently. I haven't looked it up. Somebody can look it up that's watching tonight. You can see what a 2-year, I'm gonna do it right in front of you here. I'm gonna do it right here. I'm gonna Google on my phone. A 2-year, let me do it if I can make this work. A 2-year T-bill right now, a 2-year treasury yield is where we at? It looks like yield open at 4.77. And then if you Google 4.75, if you Google 10-year treasury yield, and it's running, where'd it go? It's still at 3.6. So the 2 years are still paying more than the 10 years, but we're headed where that 10-year yield is going to get better.
Wow, that's great. Wow, so many good questions here, Billy. This is from Mark and Jennifer, who you know, Mark and Jennifer,
Oh, hey,
Sweat
Mark,
Talk.
I know them well, yeah.
They're coming to the business workshop next weekend too. We're so excited for that. They said we have $300,000 of equity in our personal home. What is the smartest thing to do with that?
Well, I know them real well, and they're a precious couple, sweet couple. They're probably right now nothing, and they probably don't want to hear me say that. But right now, I would just keep my powder dry and let's kind of wait and see which way this is going to go. Listen, I want to say this to everybody because I sound negative tonight. In here in a little while, a year, 2 years, we're going to have some phenomenal opportunities in real estate to buy. And so you just, I'm not saying you can't buy stuff now where the numbers work. The numbers work, go for it. You just got to be careful in this interest rate environment of borrowing too much money and making sure where you are. So I would say I would keep my powder dry right now.
Great. Okay. And Mike is wondering, should cash purchases on properties hold tight now? What do you think about cash purchases?
Unless I'm doing it for somebody for the goodness of my heart and just because they need a place to live, right now is not a good time to pay cash. You're going to overpay if you pay cash for a property right now. It's actually, in my opinion, it's worse than it was even back in the early 2022 when things were crazy. I think right now the prices, there are some areas where prices have come down some, but for the most part, prices have been holding pretty firm. And you have to be careful paying cash because you're going to overpay.
That's awesome. Rachel is saying, what would you suggest? She's a real estate agent working with a client that can't decide to sell or to purchase a home or to rent a home. What would you recommend?
Well, it depends on their financial situation. You know, I think if they have the resources to purchase a home and they're willing to stay in that home for a little while, then right now, and you know, when I say they have the resources, let me be clear that let's just say right now they can put 20% down. Okay. And they can, maybe they have the resource to buy their rate down a little or something like that. If they have the resources to do that and they want a home, then I think that's good. If they're putting a very small amount down, now that like the story that Mike gave at the 5.9 with, I'm assuming, is that Jared? Is that who? Yeah, with Jared. So, you know, probably for a young couple right now, that probably feels pretty good for them to get in their own house. So, but I would say right now, you just got to be careful currently getting over leverage. That's a big deal.
And how about someone that owns a home and is thinking, gosh, should I put it on the market right now to sell it or should I rent it out? Any suggestions?
I'll let maybe Mike and Frank do that one real quick, and then I'll come
Frank,
back.
do you want to answer that one?
Well, I sure want to have something lined up where I can live.
That's true.
You know, I mean, it depends. That's the lawyer's answer. But you know, we have people that are like downsizing now, seniors and things like that.
Right.
Those might be some good opportunities where they can get some good equity and then get into a house and have some cash. But man, I'd be really careful right now with your money. Just, you know, unless it's almost a sure thing.
So if someone is trying to decide like, hey, should I sell my house or should I rent it out? What should they be looking for? Mike, can you give some like insight? Like, how would you make that decision? What should they look for?
Well, I've got a young lady in our church. She wanted to sell her house because she thought her payment was a little steep. But then when she started looking at the rental market here in Pueblo, guess what? It was right at her house payment. So I said, man, oh man, I'd hang on to that puppy if I was you. I'm not going to pay rent for the same as I'm going to pay for a house payment. So I think that would be a deciding factor for sure.
Yeah, that's really good. And that's a lot of what we teach in the coaching program at the workshops too, is there's certain ratios. And in Billy's strategic real estate investing book, there's ratios that you look at. And there's 3 things that are happening when you actually rent out your home. It's not just the cash flow, but there's potential appreciation. You never want to make a decision on that, but also someone else is paying down your mortgage. So I think that's really helpful. And again, it goes back to those ratios that Billy has established that we talk about to keep people safe. This is a really interesting question. This is from V, and she says, hi, Billy, what happens when a woke bank freezes your account? Do you have to move to another bank? Do we still have access to our funds? And which banks do we trust our accounts to? And what about using credit unions? That's a loaded question.
Yeah, I think if they really froze your account, which is happening, matter of fact, just last week I was in another state and I was talking with a gentleman who owns a large regional bank in that area, and he's the owner, not just he's the president, CEO, and owner of the bank. And he told me that he had a prominent Christian ministry, speaking ministry. Now I want to tell everybody this, I'm telling this story from just 5-6 days ago. Okay. 5-6 days ago. So I want you to understand this is current right now. And a prominent, very prominent Christian ministry who a certain bank, I'm not going to say it out loud here probably, but a certain bank froze their accounts and wouldn't let them have access there in the beginning of their money. Let me explain this. This is not the bank's money, it's your money. And if they freeze your account, you get out of that bank. You go, you withdraw your money, you close your account. And then my advice would be, depending on whether you're in a large city, but if you're in a smaller town, just find some of the small community banks. They're typically more conservative anyway, and they don't have these whole departments that are all about wokeness. You know, they got all these employees they pay to do nothing but teach this whole diversity, inclusion, equity thing. They do this. And so regional or smaller community banks that way, and then you can start vetting and finding banks that will support more of our values. And usually though, those smaller community banks are that way. So if you're in a larger city area, you may have to look, but these big banks at the top of the bracket, you'd be surprised at how many Christian ministry accounts. And this is not, look, this is me talking. I don't get on and try to give a bunch of scare tactics. I'm telling you, this is real. Okay. And matter of fact, I'm sitting here right now in my office in Andrew Womack Ministries, right? And we're considered the bank's number 1 customer or number 2 customer just because of amount of deposits that we do. And we actually change we can, because of our size, we change our deposit contracts and other things with these banks, whether if there's any woke language, we take it out, or if there's any bank that has active woke policies, we don't go there. So that's the thing that sometimes in those contracts, they'll sneak in some of this woke language. The bank itself may not be proactive on the woke front, but they have some of their departments or their attorneys have snuck some of that language in. I call it sneaking the language in. But for the most part, if you just go to small community banks like that, but if they freeze your account, get out.
That's so good.
Oh.
All right. Here's a great question from Natasha. We only have time for it. We have a lot more questions and time, so we'll figure out a way to get some of these answered. Of course, at the workshop that's coming up, we'll have some Q&A Just to remind everybody, you can register for that at wealthbuilders.org/events and use the code WB200 to get $200 off. You can do live stream or in person. We'd love to see you in person because we get to talk to you. All right, so this is from Natasha, who is one of our coaching clients. Natasha, we're so glad you're on tonight. She says, thank you, Billy, for this information. She's got 2 questions. What percentage of precious metals would you advise to have in an IRA if you're in your 40s? And also, what impact do you think the 2024 political landscape could have on some of these things we are seeing in the markets and economy? That's a great question, Natasha.
So the answer to the first question about, what percentage, I think for most people, it's somewhere between 5 and 25%. Most people listening today, like probably listening to her, if she had 10% or so, she's probably okay there. But there's some popular portfolios. Let me say it this way. There's some popular portfolios that actually recommend 25% in gold, right? 25% in the stock market, 25% in bonds, and 25% in cash. So I'm not telling anyone specifically that for themselves, but that's kind of what we would call, I think the one I'm referencing is called the Harry Brown Permanent Portfolio. There's some other ones I could give as what I would call model type portfolios, but I do think you need to have some exposure. Depends on where you're at financially, but you need to have some exposure and just hold on to it when it goes up and down. Just stay with it, because in adverse times, it will always do well. In down times in the market, it'll do well.
That's
and then
great.
What was the second part?
It was about, what do you think this political landscape in 2024, how do you think that's going to impact things, and what should we be watching out for?
Well, the current political landscape with the person currently in charge of our economy, I just want to say to everybody, we just got downgraded. And that comes from an economic viewpoint, not from a political viewpoint, but the politics are saying that everything is fine. I'm telling you, everything's not fine. And so from the 2024 Republicans, we need to win back. We need to win back the White House. We need to have a tremendous presence and get the Senate headed our way where it needs to be. And I think then we'll see some things economically look better than what they're looking right now. Sometimes when I hear, I don't watch it all the time or listen all the time, but sometimes when I hear some of the comments coming out of 1600 Pennsylvania Avenue, I wonder if they're looking at the same information we are.
That is for sure. Hey, this is from David Lee. David, we are so glad to have you on. He says, hi, Billy, Frank, Karen, and Mike. David is a big friend of Wealth Builders, coaching client as well. He says, I have an investment property that is appreciated well, and he's thinking of selling it to pay down a portfolio line of credit at 7.25%. It cash flows fine. Is now time to get top dollar to pay down high interest rates?
So what I would tell you, that's a great question, David. It's a great financial question, and it's a great real estate question. So here's what I would say on that. With those that, I think there was another question on selling. David, in your particular situation, I would go fishing. So what I would do is put it out there and see if you can actually get the price that you want to get from that property. And if you can hit your price target, then sure, take that money and pay that down for you. But the only way is you got to go fishing just to see what kind of offers that you get. And then the truth of the matter is, remember, the real skill here is once you get out, you go fishing, you start getting some bites, then it's negotiating. So just make sure you know what the rails you want to run on are and stay on the rails. Don't get off. In other words, stay with your parameters, stay with your guidelines of what you want to get out of the house, and don't compromise in areas that you shouldn't. And so I think if you do that, you can go fishing and just find out exactly what's out there, and that'll help you make a good business and financial decision.
Wow, that's awesome. I can't believe the hour is up already. This has been phenomenal. And I know we have a lot more questions. Again, we will work to get those answered for you through additional webinars. We do a weekly podcast. But really, the call to action tonight is for you to join us at the Business and Nonprofit Workshop next weekend, August 18th through the 20th. We will all be there. Billy will be doing some more Q&A. And so I would just encourage you to invest in yourself and be a part of this. Go to wealthbuilders.org/events, and we've got a $200 off coupon for you for attending this webinar. It's WB200. We would love to see you there. So with that, Billy, any final thoughts you'd like to share with everybody on tonight?
Well, I'd like to say, because of some of the very specific questions that were asked, I want you to hear this. If you really have specific questions on securities, stocks, bonds, gold, things like that, that you really want answers on, I'd encourage you to contact Wealth Builder Investments. Karen, I have to remember what that website is, but
It's
can
wealthbuilders.net.
wealthbuilders.net. So wealthbuilders.org is where we have all of the normal stuff we do. Then wealthbuilders.net is where we have the actual investment information. And so, because a few of you, I heard some questions in there, I think you could use some specific direction. So just to let you know that, wealthbuilders.net. But I think right now, Karen, to close this like this, I think right now, I don't normally end the webinar myself this way historically, but I'd like to pray for people.
Awesome.
So can we do that?
Yes.
So Father, today we come to you in this webinar and we thank you that, Holy Spirit, you are the teacher of the church. And we thank you in Jesus' name that you lead and guide us into all truth. So I pray for people today in specific situations in their life, Lord, that they're facing questions that they have. I thank you, Lord, that you're leading and guiding them into all truth. Take the things that we said tonight, I pray, and the information that we shared, and let them and teach them and show them and help them apply it in their lives where they need it and they can be fruitful with it. And we thank you for that in Jesus' name. And everybody said, amen.
Amen. Thank you, Billy, Frank, and Mike. Thank you so much for being a part of this. And I want to thank all of you for being a part of this amazing Wealth Builders family. God bless you and have an amazing rest of the night.
Bye.